on how to manage volatility in your portfolio, we're joined by Rob Lauzon. He is Managing Director and Chief Investment Officer at Middlefield Capital Corporation. Thanks so much for joining us, Rob.
Yeah, good to be back. Thanks for having me.
So I wonder if, first of all, we could just start with your thoughts on what's happening in this particular moment, because, we've seen a lot of selling since last week, since the Fed, decided to hike rates, but also lowering expectations for growth, raising expectations for unemployment. Today, though, we saw maybe a moment of optimism at the start of the trading day, but lost hold of that. It's a bit of a mix out there right now. How do you make sense of what's going on?
Yeah, well, you touched already on a few points, but essentially when the Fed has committed themselves to continue to raise rates, that moves up bond yields to, the level that they're guiding to. And really, it's the 2-year bond that I'm paying attention to. If they do end up hiking rates on the short-term basis to 4.5%, that 2-year bond still has a bit of room to grow higher on the yield side. So what that does is attract capital, global capital. There's a debate how deep a recession, if we're going to have one in North America, is, but in Europe, it's pretty obvious there are some issues there, and they're probably in a recession right now. So capital is flocking to the US dollar. So the stronger dollar causes earnings to grind lower on multinationals. So, the market right now is on a pause mode because we really want to see what companies are about to say in Q3 about guidance for the rest of the year and next year. How drastic will the earnings cuts be because demand is slowing and because of foreign exchange headwinds? And so the market's not willing to do much here until we get that. So you get these fits and starts where you get, this morning there was, the US dollar was down a bit this morning overnight, which caused equities to rally. That fizzled out because bond yields started rallying again midday. So it's a tug of war. We need to see clarity on earnings. I think that's the next, we know what the Fed's doing. They've told us. Mm-hmm. So now we need to see earnings, which we've got 2, 3, 4 weeks here ahead of us. Okay,
so what do you do in the meantime? You're focused on dividend-paying companies in particular?
Yeah, at Middlefield, our DNA is equity income. So that doesn't mean that stocks can't go down, but we continue to get paid. Part of our total return of our funds that we try to give to our clients incorporates a level of dividends. So over the long run, dividends is anywhere from 1/3 to 2/3 of a total return on an equity investment. So anywhere from 2 to 6% can come from dividends, and reinvesting that dividend is very important. So that's kind of high level how we look at stocks. We're looking to provide that long-term equity rate of return, 6 to 10%, to investors to complement their bond portfolio. And if we can start the year off knowing that we're going to get a dividend of, like I said, between 2 to 6%, depending on the company, plus a growing dividend, we like to buy dividend growers, that helps us achieve our goals for our clients, which are trying to meet their long-term investment financial goals.
So would a lack of a dividend turn you off entirely right now, or would that still be a company that you'd consider just on other factors?
Yeah, definitely the latter. I would consider it. But we can get, typically companies that don't pay a dividend either aren't profitable and can't afford one. So that's a red flag. Not to say you can't trade around those names, but lower dividend payers, there's some, typically a lower dividend paying company would have more growth. So you can go after total returns on a company like that from trying to get 12% earnings growth or equity growth in the share price coupled with a 1% dividend. So there's different levels, but yeah, we do have room in our portfolios to have non-dividend payers, but then you've got to be more correct on the capital gain portion of the total return, obviously.
So Rob, which sectors are you looking in right now for companies?
3 areas we've liked all year. We've liked healthcare. It's down on the year, but it's down about half as much as the market is down. So our healthcare funds have been generally insulated. They're very profitable companies in the healthcare space. They have low debt, which is important because you've been showing bond yields for the last week or two, probably a little more than you normally have, but you can get 4% now, 5%, 6% on bonds. So what does that mean? Companies have to pay that to borrow. So it costs more to borrow. So if you have a company like a lot of healthcare companies have low levels of debt, that's a tailwind because they don't have that high level of interest costs facing them. And typically healthcare companies are dividend payers, dividend growers. So that's one sector. We do like pipelines. We continue to move molecules around the world to heat our homes, to travel by car, by air, to generate electricity, and that requires pipelines. So they have generally strong, stable, contracted cash flows and have parts of their businesses that are growing, and that allows them to pay strong dividends to us. So we do like pipelines and real estate. Within real estate, we're sector specific, but we do like apartments and industrial REITs that have pricing power right now that are actually still able to increase rents to offset inflationary forces.
And just quickly, Rob, if you could go through just a couple of quick examples of companies that would fall into those categories, of sectors that you are looking at right now.
Yeah, so this year in healthcare, we've been buying AbbVie, which is more or less a pharmaceutical company. It's been growing its dividend year after year. It trades at about 12 times earnings. And we think 2024, 25 has a lot of growth outlook for the company. So, I would buy AbbVie and hold it for 2 to 3 years here. You're going to get a high level of dividend growth. Plus, over that 2-3 year time frame, we think you can make a pretty good capital gain as well. We like Enbridge down here. It's about $10 off its high. So you're getting a dividend over 6%. And, it's no longer $60 a share. It's close to 50. That's always been a buying level for us on Enbridge from a pipeline standpoint. And on REITs, we actually had lunch today with Granite REIT, an industrial, the largest industrial REIT in Canada. They have properties in Europe, US, and Canada. So essentially, the theme there is as more onshoring happens. So for example, Intel is an example of semiconductors no longer being made offshore, being made onshore North America. That requires space to basically store things. So you can think of that as a trend that's going to be happening, which is why we still like industrial stocks.
Rob, great to get your ideas today. We appreciate it.
Yeah, good to be back. Thanks.
That was Rob Lauzon, Managing Director and Chief Investment Officer at Middlefield Capital Corporation.